As an investor, how can you survive the current market volatility? To answer that question, we have to look at why the markets are becoming hesitant and fearful. This past Friday, the jobs report came out much stronger than expected, and as a result, the markets fear the Federal Reserve, or the Fed, will keep interest rates high for longer.
Yes, the big March jobs report hitting the wires. Non-farm payrolls, a whopping 303,000, that most estimate, and goes right along with the whisper number, which was higher than the estimates due to the strengthened ADP. 303,000, that's the juiciest number that we've had going back to 303,000 equals May of 23, right on the nose. To find a higher number, you go back to January of last year.
So what do the markets do when they fear high interest rates? Well, both bonds and stocks fall in price. And of course, last week, the Personal Consumption Expenditures Index, or PCE index, was released. And as you can see from this chart, the PCE has been accelerating as of recently. Now, I didn't have these last couple of data points in my graph from last week, but I added them for the graph this week. So you can see this is up to date, and you can see that the slope here is kind of on par with where it was back here when it was really hot. So the markets are looking at this and going, wow, the Fed is not going to lower rates if this continues. In fact, they could be inclined to raise rates. Now, I don't think they're going to do that, but I think that's what the market's reaction is saying. Then to add icing on the cake, you have articles like this posting on CNBC that get the believers in this type of things to start taking action and hedging their portfolios or selling their holdings. So if enough people believe this, then when those conditions happen, those people will either buy or sell and cause the markets to move. Once that runs out, then the markets go on their merry way. So look, the wall of worry is alive and well, but as a long-term investor, should you pay any attention to it? If you're a regular viewer of my videos, you'll know the answer. It's a resounding no. Take the long view and keep dollar cost averaging into your investments, and you'll be just fine over the long term. Now let's take a look at the wall of worry and what the charts and metrics are telling us right now. So if we take a look at the equity markets over the past week, you can see that they all finished the week lower. And by the way, in my video last week, I predicted that the markets were likely to move higher, and I'll discuss that when we get to the bottom dynamics. I think I understand the mistake I made. So clearly I was wrong this week. The markets moved lower this past week. And you can see, though, there's kind of a mixed risk appetite here. Small caps and ARK Invest, the riskiest stocks, finish at the bottom. That's not what you want to see. But the Dow was kind of in the middle here, and the S&P and the NASDAQ did the best over the week. So really kind of a mixed picture. What about over the past month? Well, if we look over the past month, again, a very mixed picture. Same thing as over the past week. We've got ARK Invest finishing last, small caps second to last. Then we've got the Dow and the NASDAQ kind of neck and neck here, and the S&P finishing the best. This is a very mixed picture. It's not a healthy, let's go for the highest risk assets type of market right now, and that gives me a little bit of pause. And then if we look at year to date, again, same picture, very similar. And then if we look back over the past year, again, a very similar picture with ARK Invest sort of doing better than small caps in the Dow, and the NASDAQ leading the way higher. So this is fairly healthy, not as healthy as I'd like to see it, but it's a fairly healthy looking picture. So if we take a look at the current bottom dynamics, you can see what the mistake I made here. You can see that the bottom confirmation was sitting up here at 100%, and at the end of the trading week last week, you can see that the confidence level was shooting straight up here. But what I didn't pay attention to was this confidence level is down here at 60%. That's not very good confidence. In fact, you can see that since back here, the confidence level has been running anywhere from the high 30% range to the low 60% range. So not a very confident market. Now, you're going to say, yeah, but Calvin, look at back here. It was negative. You had negative confidence. That's usually an indication that you've kind of reached an extreme from a negativity standpoint. And you can see that from that point forward, the markets did move higher, but not in a very strong way. Now, where are we right now? So now the confidence has moved up. We're just touching 80% confidence-wise, but you can see that the confidence is still moving higher. Now, the bottom confirmation level is moving higher. The bottom forming indicator is moving lower. So looking at these signals, I would say we're going higher next week. Now, hopefully I won't end up with egg on my face again. And let's take a look at the price action. So you can see back here that the price actually had a fairly nice slope to it. That's this green arrow that I've overlaid on here. But then more recently, it's subtle, but you can see the slope of this sort of greenish yellow line is a little bit less than the slope of this green line. And then let's go to the present. Now we're pretty much flat line. So this is not looking great. And I really do hope we go higher next week and we break this roundness here and we start to head higher again. We'll just wait and see what happens. And what if we look at risk versus opportunity? Well, I'm liking what I see here. You can see that risk acceleration is declining. It's still too high. I don't like it when it's above 60, but at least it's moving in the right direction. Now you can see that the risk level, this red line, is moving higher. And this is very much a lagging indicator. So it'll be a while before this moderates and starts to head lower. This yellow line, risk acceleration, will have to continue lower in order for that to happen. And then opportunity level, the blue line, is still at a reasonable level. It's above 65. And you can see it's been kind of declining, but this is also very much a lagging indicator, just like the risk level. So I really pay a lot of attention to this risk acceleration signal, which is declining. And I'm happy to see that it's doing that. Okay, let's take a look at equity versus safety. So I'm just going to go right to the overlay because I think that that's a little easier to look at than all these symbols here. So what's going on here? I don't like the cash is up here in number 2 position. I don't like that gold has stayed up in the number 1 position for 5 weeks now. This is not looking good. Now, where's the bright spot? Well, small caps moved up. That's great. But the NASDAQ 100 has moved down. In fact, now it's even further down. It's in 7th position, where back here it was up in 4th. So kind of a mixed picture here, but I also don't like the fact that the S&P 500 and the Dow have both moved down and they've been displaced by cash. Or let's put it another way, these moving down has probably pushed cash up here. Cash really doesn't move. So I don't like this. This isn't looking great, but this is also in conflict with some of the other things we look at when we look at sector rankings and sector rank acceleration. You'll see that they kind of oppose this view a little bit. And what about safe haven assets? Well, if we look at these, they look like a bowl of spaghetti back here, but you can see again that gold has stayed up here in the number 1 position for 5 weeks. You can see that long treasuries just shot up here back here for 2 weeks and then just collapsed. So where are we now? Well, we have an unhealthy risk appetite for long duration treasuries. So I would say that we have an unhealthy treasury market, and cash, as I mentioned, is moving higher. This is concerning. And how does all of this show up in the buying and selling pressure? Well, you can see not a good picture. We've had price declines here in the Dow. We've had price declines here in the S&P 500, in the NASDAQ, and in ARK Invest. And you'll see also when we get to small caps that things don't look great there. And you can see what's happening. The buying pressure peaked out back here and has been declining, and the selling pressure is increasing. Same thing for the S&P 500. Not quite as drastic for the NASDAQ 100. You can see that they're kind of down here, not really making any big moves one way or the other. And then for ARK Invest, you can see the same thing here. Collapsing buying pressure and increasing selling pressure. What about small caps? Well, small caps, you can see again, declining price, as I mentioned, declining buying pressure, and increasing selling pressure. This is not a good look. It'll be interesting to see if we actually do go higher this coming week. And what about sector rankings? Well, these are a longer view. They don't move very quickly. And I would like to believe pretty much what I see here, because what I see is that Bitcoin and semiconductors are ranked number 1 and 2. NASDAQ 100's up here. This is last week. And cash is down here. Treasuries are down here. This looks like a very healthy market. Now, where are we this week? Well, cash moved down a slot. That's even better. And consumer staples and discretionary stayed put, but gold moved up in the rankings. But you can see that the NASDAQ pulled back a notch. The S&P 500 pulled back a notch. So it's still looks fairly healthy, but it's, in some ways tilting toward higher risk and in some ways tilting toward lower risk. What about sector rank acceleration, though? Sector rank acceleration, last week we had cash way up here. We had treasuries up here, consumer staples way ahead of consumer discretionary. This is a fairly unhealthy looking risk appetite. Now, what if we fast forward to this week? This one really I find interesting because cash has moved way down here. Consumer staples have moved down here while consumer discretionary has moved up. So this looks healthy. This is what I mentioned earlier when I said that the sector rank and sector rank acceleration are really in contrast with the other metrics that I showed you, because this looks fairly healthy. Now, what's surprising here is that this is also showing a move toward a healthy treasury market with long duration treasuries up here, long to intermediates here, and intermediate treasuries here. So shortest duration here and highest duration here. That's a healthy looking treasury market. I'm encouraged by that. So we'll see how this goes going forward, but I like what I see here. I hope this keeps it up. And you can see that ARK Innovation moved from back here to up here. This looks really, really good. And what about treasuries? Well, if we take a look at treasuries, you can see we had a very unhealthy week for treasuries. The longest duration treasuries finished down almost 2.8%. 20-year bonds down 2%. This was not a good week for treasuries. And it's understandable given the jobs report and the accelerating PCE report. Even though the Fed said they're not going to raise rates, and in fact, they are going to lower rates. But I guess investors, as they call themselves, are not listening to that. What about over the past month? Well, you can see over the past month, same picture, unhealthy looking treasury market. Let's take a look at year to date. Well, year to date, same picture, unhealthy treasury market. What about over the past year? Unhealthy treasury market. And then if we look back over the past 5 years, you can see that unhealthy treasury market. But we're kind of, near the bottoms here. So if the Fed does in fact start lowering rates, these lower risk investments that are down so much should perform fairly well going forward. And what about the buying and selling pressure for treasuries? Well, if you take a look at this, shorter duration treasuries have actually performed relatively well. They were declining here, but the price action has been on the increase here in general, even though they pulled back on Friday. But you can see that the selling pressure peaked out back here, and has been somewhat in decline, even though it's increasing recently, and the buying pressure is decreasing. So this doesn't look great. For intermediate treasuries, more of a sideways price movement. But again, the selling pressure has been moving higher here, and it's above the buying pressure, the solid gray line. What about intermediate to long treasuries? Well, again, you can see that the price is declining and the selling pressure is moving higher. And then the long bonds, 20-year bonds, TLT, declining price. And interestingly enough, if you look at this, the selling pressure is kind of on a decline if I were to draw a trend line through this, and the buying pressure has been increasing somewhat. So maybe this will turn around, but we'll see. And what about that inverted yield curve? Well, it's gotten a little better, actually, surprisingly. And why has it gotten better? Because long duration yields have gone up. You can see that the current, this dark blue line, is higher than it was a month ago. And that's causing this to become less inverted. In fact, if these were to move up here and these were to stay put, the yield curve would not be inverted anymore. That would actually not be that healthy. What we want to have happen is we want the Fed to lower the rates down here. And if they lower, which is where they control things. So if they lower these rates and these rates stay put or maybe go a little higher or even drop a little bit, then this yield curve will become uninverted. Now, it's moved a little bit in that direction again because at the long end, yields have gone up. So last week, this was over 40 basis points inverted. Now it's 35 basis points inverted. So I guess you can call that an improvement, but I don't like the way it came about. And what about the Fed rate monitoring tool? Well, this is an interesting story. So now, this week, there's a 95% confidence level that when the Fed meets in May, they will not move rates at all. And if you contrast that with a week ago, you can see that there was that there wasn't as much confidence. Now 90%, 90.7% is fairly confident that they're going to leave rates the same, but you can see it got worse after the jobs report. And then what about June? Well, June, it starts to look a little more likely that there will be a 0.25% interest rate cut. It's kind of a 50-50 guess here. And then if we go out to July, you can see that it gets to be a little bit higher, that there will be at least a 0.25%, if not a 0.5% interest rate cut. And then we go out to September, the numbers keep going the way you think they would. But what's interesting is you can go all the way out here, all the way to the end, all the way to July of 2025. So more than a year from now. And you can see that there's still a little likelihood that the markets think interest rates will be where they are. That's a little scary, and I really hope they're wrong. And what about gold? Well, gold has been the place to be. You can see that it's had a very nice rally. It kind of consolidated here, and now it's on an upward move again. Now the buying pressure, the solid gray line, moving nicely higher, and the selling pressure, this solid orange line, is moving lower. So this looks really good for gold. Now what's driving this? Is it a fear of inflation, or is it geopolitical risk? I don't know. I mean, clearly the markets are showing fear of inflation, so maybe that is playing into this. Last week I said I didn't think so, and I kind of still don't think so. And I think the markets are going to be wrong. I think that inflation will moderate. I think it'll come down. And I think at some point the Fed's going to be dealing with deflation, not inflation. And what about Bitcoin? Well, Bitcoin had a spectacular rally, and now you can see that it's sliding sideways to down. So going through a major consolidation here. And you can see that while the selling pressure peaked out way back here, it has been on a decline ever since. And the buying pressure is trying to move higher, struggling to move higher. So I don't know where this is going to go. If you believe what everybody says out there, Bitcoin's likely to go to $100,000, $500,000. That's what they're saying, and could happen. So if you're an investor, you keep like 5% of this, or 10% at max, but I would say 5% or less in your portfolio, and just keep holding it if you believe the story. If there's one thing to take away from my market review this week, it's that the equity and bond markets are skittish and on edge. Oh, and then there's the sell in May and go away crowd that we might just have to contend with in a few weeks. You can't make this stuff up. This is why I produce these videos every week, so you can keep grounded and sane through all this noise and nonsense that, quote, investors concern themselves with. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips, but the sun's stronger. Pour it out, if I'm being honest. It's just not everything you promised. Running out, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold-proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water.